you hear me?
Yes, I can hear you. Can you hear me?
I can, Cass. Thanks for having me on. I appreciate it. Glad you
All right. So thank you
just,
so much for joining
today.
us. Yeah, what's a big blessing it is to have you here. I want to give people kind of an understanding how big of a deal it is, because to have an actively managed normally, Dave, let me ask you this. Normally, in normal cases, how much money people need to have their money actively managed?
They don't need it very much money.
No, I know. In our case, I know in our case, but I'm just talking about in generally, without what we're doing, because I want everybody to understand this. Generally, to have actively managed, you got to have a lot of money. But because of the relationship with the Trans-America Financial Advisor, because we're taking this information to the masses and we're revolutionizing the way financial services is getting distributed, we went to Global Summit, and we can take people with very, very low money and do that. So, but as well as I do, that if somebody were to go, let's say Goldman Sachs or any actively managed, normally would cost what?
Oh, it's going to cost them an arm and a leg. Yeah, absolutely.
A lot. They got to have a lot of money. So, hey, thanks for being here. Man, I'm excited. So, let me bring up this PowerPoint. This which is your PowerPoint. I'm going to bring it up here. So we want to talk a little bit, Dave, about actively managed versus passively managed. So I want to put up your, I know there's some disclosures I got to put up here. But let's get into it. I want you to give a simple example, like, as I'm bringing this up, maybe you can give an example. Let's say you have a 10-year-old. And there's a 10-year-old, because, the tendency of financial companies is that they kind of talk over people's head. I remember I used to meet all these financial guys, and when they would talk, and we were golfing or something like that, and I'm like, man, I didn't understand half of what he just said. And it was just, they talk this big vocabularies. So just if you were to explain this to a 10-year-old, how would you explain an actively managed versus passively managed?
Yeah, that's a good
PowerPoint.
Yeah. If you turn to the PowerPoint, page 15, but I'll just explain it. It's in a lot of respects, it's very simple, in the sense that an active portfolio or an active manager is seeking to hold companies or hold securities, stocks that they feel like will do well, and not hold companies that they feel like will do poorly. So if you feel like a company is going to go to bankruptcy or what have you, this is a company you don't want. And an active manager can hold that company or not hold that company, where a passive investment, if it's in a big market index like the S&P 500 of 500 companies, you're going to hold it regardless of what's going on in the company. So if the CEO or the president of the company is having misconduct or gets fired for something that they've done poorly, you still are holding that company. Where an active manager can sell that company and get into something that's better, hopefully. And that's the primary difference between active management and passive management. The idea of active management is to reduce your downside exposure or your risk to lose money, and hopefully increase over the long term your ability to make money.
So let's give an example over S&P 500, because we've been talking a lot about S&P 500 right now. So can you give an example? Like, I know you were talking about Boeing. I think that was a good example everybody would relate to. So Boeing being one of the top 500 companies in the S&P 500.
And there's a lot of companies just like Boeing. But take a look at Boeing. It wasn't too long ago, and everybody can probably remember that Boeing had some problems with their airlines and had a number of crashes, right? And if you think back during that time frame, why would someone want to hold Boeing when they are not able to sell any airplanes? So when a company is not able to make sales, why would you want to buy that company? Get another company that actually is producing some product that's actually having sales.
Good. Okay. That makes sense to me. So, okay, let's go to your this first slide right here. Let's explain this to them real quick. What does this mean? So we got return on one side, everybody, right here. We got the return on this side. And then we got the risk on this side. So, and then there's a line right here. Okay, this is called capital asset portfolio model. And then you got minimum variance portfolio, efficiency portfolio. So explain to us, what does this even mean? Who is this guy right here? What's this 1952? What's this?
So this is Harry Markowitz. And Harry Markowitz is really the father of modern portfolio theory, which big words for that the riskier asset classes like stock outperform the more conservative classes over a long period of time like bonds. And so back in 1952, they didn't know this. They were just investing in different things, hoping to get as best return they can with as least risk as they can. But we know this now. And this is held true. And it's been around for over 70 years almost. And so what we're looking for is if you have more aggression, or excuse me, if you are wanting to be more aggressive or more conservative, that will help you to determine how much stocks versus bonds versus cash you can have in your portfolio. So if you go to the next slide, Cash, clearly you can see the black line is the S&P 500 over the last 30 years. You can see that this line is much more volatile. There's a higher chance of losing money at any one period of time than the red line, which is bonds. But the reality is the black S&P 500 stocks have outperformed bonds. So across asset classes, more risk has equaled more return over a longer period of time. The problem is that we have interpreted this and said, okay, I want to put into stocks, I want active management, and I want really aggressive risk because I want a high return. But the reality is if you stop looking at stocks, bonds, and cash, and only look at stocks, look at your next slide, you'll see that if you go really aggressive in stocks,
so
you end up losing more money. Yeah.
So this is annual return, everybody. So this is the return we're getting. Let's make sure they understand it. So 7, 8, 9, 10, 12. This is the return that we're getting. And this is the risk that we're taking, okay, on this side. So this is the risk. So if I come here, right here. So if I'm taking, what would you say this number is? Let's say 13. If I'm taking risk of standard deviation of 13% risk right here. And I'm getting a return of, let's say, 11 point something percent. And then what happens as I take more risk, then I get a little bit more return. Then I take a little bit more risk, I get more return. But watch this. When I start taking a lot more risk, I actually end up getting less return. And when I take a lot more risk, I end up getting a lot less return. Did I explain to them?
Perfectly. And so the idea here is you do not have to take high risk in stocks to get a good return. Managing your risk in stocks is much more important. For example, what if you put in $10,000 into the S&P 500 in 1970? What would your return be today? You'd have about $300 some odd thousand in return. But if you could take less risk and not at such a passive approach, take an active approach and manage your risk, and let's say that every time the market went down 10%, you only went down 5.5% because you were managing your risk. You didn't buy Boeing or whatever bad stock was out there right at the time. And when the market went up 10%, well, maybe because you're managing risk, you weren't a high flyer, but you were up 8% of that 10%. So managing downside risk at 55% and managing upside risk of 80%, how much more money would you have? Just investing a one-time $10,000 investment. Go to your next slide. You can see very clearly over $1 million more. $1 million more. And so somewhat the slide speaks for itself. You see my notes there. I don't need my notes. But the slide speaks for itself in the saying that if you are going to take an active management approach, the most important thing I've learned over the last 30 years of managing money is that it's more important to protect your downside in stocks than it is to try to find the next winner. Okay? The tide will raise all your boats in the stock market. When the tide comes in, you're good. But if you're in a boat with a hole in it, you're going to sink. So it's really important to be active and to manage your risk in the stock market, your downside risk. And that's what we do at Summit, in the sense that we take a managed risk approach to investing. We don't want to be in any companies that are going to have surprises. We don't like to be surprised. No one likes to be surprised. And so that's the key to making money in stocks, is take an active management approach and avoid losses.
So let me explain. Let's see. I want to make sure we got this. So we're talking about if we want to get 80% of the up market and only participate on 55% of the market when the market goes down. Okay, that's right? And we're using S&P 500, and assuming that this strategy was done exactly, and we go back to the beginning, 1970, up to right now, we basically end up with $1 million more with that strategy. So, because an actively managed account has a higher fee, correct, depending on how much money they put in. I mean, you guys have your fees. We work with multiple companies, but sure. They just do. But as long as I'm getting my return is more than what I would have done in the S&P, who cares, right? Am I correct about that?
Absolutely correct. You could pay a fee, but you're not going to pay $1 million in a fee.
Yeah. Yeah. Okay, got it. Okay, so now let me stop this. I want to ask you a question. Let me stop this graph. So, can you? And I appreciate you jumping on. Just a little bit of strategy, a little bit of story I want to see on you. Why is that a big deal that you guys won that award?
Well, I think what it says is that, you don't have to be Goldman Sachs to have the best money management. What you have to have is a really good design, a really good process, and a great team. And you can have that in anybody, right? I mean, we have that. We've hired really, really good people. We have really, really good processes. And consequently, those processes led to very good awards over the years. We've won awards in 2019. We won awards in 2020. We've won multiple different awards for being a great institutional asset manager.
So, I want to talk about this because, I have an account with Summit, but we have different money managers, actively managed accounts. It's not Summit. We have multiple different ones, but I have an account. So, and I talk about this because I love our platform, and I wanted to kind of get your view on this platform, because through this open platform, right now we can really help anybody. It doesn't matter if somebody got 10 grand or millions and millions of dollars. And this is what I love about this. And right now, Dave, we have this campaign that we really want to educate massive amounts of people through the platform that we have, and not only educate them about money, but we also want to give them the opportunity to be able to, at some point, maybe even have their own businesses. I was just talking about the advantage of having a business when it comes to taxes. So let me ask you this. When it comes to this, what would you say, I guess I'm trying to see what would be the right exact question to ask you, is that, have you ever seen this happen or from an outside perspective, that anybody's done what we're doing? Like today, I mean, I told you earlier all the stuff that we covered today. I mean, does that happen in the financial business?
No, you guys are amazing. You're doing a great thing. You have a great plan. It's a fantastic business plan. And the best thing about it is anyone can do it. You do not have to go to New York. You don't have to be hired by Goldman Sachs. You do not have to graduate from Harvard, right? You can do this wherever you're at with the resources you have and the people you currently know.
Yeah, it's because
the key.
This is the business model. We don't manage anybody's money. We have people like Dave and many other people that we leverage. We just do the education. And that's what I love about what we do. So anyway, thank you, Dave. Thank you so much. Hey, we got to do an event. We'll do an event. Get there and we'll do a whole thing so you can kind of go through the entire part. But I just wanted you to come on. Thanks for being our guest here. I appreciate you, brother. You are absolutely, absolutely awesome. So thank you. Can I have my PowerPoint back on? And just to finish it on college planning right here. Again, I told you guys we had